All right. Morning, everyone. Welcome back to Morning Kappa at 8. Looking at the Hang Seng Index, I can see that the the index is staging a very strong rebound. Right. It has been moving up for the past 2 days. And looking at the also on the crude oil, right? The crude oil staged a rebound as of yesterday, right? The news was saying that Iran is considering to let some of the non-hostile ships to cross the straits, but not much details to be heard. And nonetheless, the crude oil continue to stay above the 85, and we do see that very strong support at 80. So as long as the crude oil US oil stay above the $80 per barrel, right? Overall, technical setup remains bullish, right? And that's of the gold, right? Since the equities market also are rebounding, the gold also take this opportunity to rebound, moving higher, right? However, the strong resistance should be at 4,008 and followed by the 5,001. As you can see right now, there was two bearish Marubozu that have actually show that the market sentiment was weak. So we see that for a longer term perspective, right, gold should climb above 5,001 to show more evidence on a longer term bullishness. So at this juncture, we still keep bearish bias until a bullish breakout on 5,001. Now, as of the E-mini, right, yesterday market do see some rebound. However, the index have yet to cross above the 47,000 point. And you can see that right now, this E-mini, which is the Dow Jones index, the Dow Jones index, right now trading above, below the long-term 200 days moving average. So if you compare a few indices in the world, right, the US index is actually together with the European index both in a very deep bearish territory right now. So as for the E-mini futures, we still keep bearish trading bias until the E-mini could break above 49,000 point level. Now, in the local market, FKLI show a very strong resilience performance over the week. Right now, after the corrections that we've seen 2 weeks ago, right, we almost recoup most of the territory. As of yesterday, the FKLI eyeing to cross above this 50 days moving average. Now, remember the E-mini was below the 200, and as the FKLI right now we are eyeing to cross above the 50 days moving average. So we still keep a bullish bias on the FKLI, and on the downside, we just have our stop loss at the immediate support at 1680. Okay. As for the FCPO, the extent the consolidation yesterday, bullish momentum was decelerating. We have revised our stop loss for 4,002 to 4,004. Right, we just see that I think that before we end the week, right, next week market may be more volatile, right? So we have a more prudent strategy, right? Revise upward our stop loss point from 4,210 to 4,004. As for the trading stock this morning, firstly, we'll look at the Asia X. If the sentiment becomes on again, right, Asia X may break past the 1.27 ringgit. Now, if the breakout happen, it will climb towards 140 and followed by 150. Right, downside support is at 1.15 ringgit. Now, secondly, the Eco Shop have come to a very important level, i.e. 1.30. So if today it managed to climb above 1.38, right, that shows that bullish momentum re-accelerates, and Eco Shop may test the R1 at 145 and followed by R2 155, right? So we have two pending breakout, Asia X followed by the Eco Shop marketing. So I'll stop here and pass on to Jeffrey on the KGB report. Thank you.
Okay, morning. We have a company update on Kelington Group. Basically, we see another strong year of earnings execution, notwithstanding the Middle East conflict. Investors should accumulate on dips. Store fundamentals are strong, supported by structural growth in the chip sector, balance sheet strength, as well as dividend upside. The Middle East conflagration has spiked up energy costs and disrupted the supply of helium, which is basically a key inert gas used in the wafer cooling process. Now, we do not foresee this pending the structural growth story. And obviously, the semicon side of things, the foundry investments will continue, although there could be some short to mid-term disruption risks as supply chains are recalibrated. Now, also note that the shortage in global memory chip supply has accelerated foundry investments globally. Kelington Group, KGB, is at the forefront of this structural push. If you look at the year-to-date order wins, it's actually 42% higher year-on-year in the first quarter. They are targeting 1.5 to 2 billion new orders for this year. Last year, that number was about 1.25 billion. Just 2 days ago, they've secured a 414 million turnkey gas distribution system project from India's Maiden Foundry. This is part of the Tata Group. They're hopeful of bagging another quite chunky chemical package tender, hope to be announced in a couple of weeks, or possibly by end of April. Some of the key tender outcomes that we should be on the lookout for going into the second quarter and the third quarter are, quite a number of new hookup jobs in Singapore, easily worth $500 million here. Project tied to a second German foundry. They've done a Finnian foundry in Dresden last year, so they're getting into this second foundry. It's a tie-up between TSMC in Taiwan as well as Infineon and Bosch Group over in Germany. It's called ESMC. And there's also vying for a very chunky GC or general contracting job related to another quite an old foundry here based in Selangor. That job could potentially be worth about $1 billion. Now, if you look at this particular job alone, it could actually fuel order wins to another record high in terms of the FY26 numbers. Kelington has about 95 million outstanding warrants as of end of fourth quarter. This is actually worth 131 billion itself, 15 cents a share. If proceeds exercise, or rather the warrants exercise prior to the 24th July expiry date. So I think some of these proceeds will come back by way of potentially special dividends going forward. Last year, they've paid 2 rounds of special divs already in the third quarter and fourth quarter. Dividend payout ratio was also a record high last year at 66.4%. So we're assuming that trend will continue. Just a little bit in terms of the industrial gas side of things, the trading of gases was a bit of weak last year. That's also because of a planned shutdown by one of the major customers in Sarawak. I think that's now behind. They're actually looking for new specialty gas customers out there. I think more interestingly is basically the venture into RE as well as the bio-CNG side of things. So they're actually involved in the construction of upgrade facilities for the production of biocompressed natural gas. This is basically using the palm oil meal as a feedstock. Also setting up a 2 megawatt electrolyzer plant for the production of green hydrogen. They've signed an MOU with Worldwide Energy last October. I think the term sheet is being finalized. Formal agreement is expected to be inked, the next couple of weeks, hopefully by the end of this second quarter. Discussions are also ongoing for new on-site gas supply projects. They're actually talking to several parties out there. Hopefully, we can actually see some closure in terms of new agreements, in terms of the on-site side of things. Forecast-wise, we've taken the opportunity here to actually raise our 26 to 28 numbers, by between 7.311 and 9.2% respectively for the 3 years. This is basically to factor in some adjustments or upward adjustments in terms of order book replenishment assumptions for the 3 years. Year-to-date run rate in terms of new orders, they're doing a 555 million already with the 3 or 4 new contracts. So I think second half, you see a bit of ramp up. So I think easily they could actually, manage about 1.5 billion in terms of new orders for this year. Tender book still very healthy there. It's still at a record high of over 4 billion ringgit. So we're maintaining our buy call, target price 680 from 650 previously. I think the reason why we've views, the upgrade was much smaller relative to the increase in forecast. It's really because we've taken down the KL Tech mean P to 26 times, which is actually the basis used for our target price, from 28.8 times previously, obviously due to the sentiment around geopolitics. And so keeping our buy call at new target price of 680. Okay, that's all from me. I'll pass on to the next speaker. Thank you.
Okay, thank you, Jeffrey, for the presentation. So now, moving on to me, we have issued a trading idea report on Lim Seong Hai Capital Berhad today. So let me just share my screen. Okay, so to introduce, Lim Seong Hai Capital is a vertically integrated contractor and property developer, now expanding into concessions. So now we look at its construction sector first. So it has the market leading profit margin in construction. So Lim Seong Hai Construction and construction profit segment remains the group key revenue drivers, which contributing more than 60% of its total revenue. The segment delivers an industry outperforming GP margin of 35%, supported by cost efficiencies from its best collaboration framework, which you can see in my figure 5. An integrated model where 90% of construction products are used internally and can be reused across projects. As at 1Q FY26, the construction order book stood at 1.3 billion, which is more than 7 times of FY25 construction revenue, providing earnings visibility through FY29. Around 60% of the order book is tied to in-house property development projects, while 32% relates to external infrastructure works. The group also has 30 billion construction tender book, particularly for external infrastructure projects. So as for property, we see property-driven multi-year growth. The property development segment is underpinned by ongoing projects, notably LSS Sega, which has a GDV of about 400 million. And right now having a 90% take-up rate, as well as Lakeside Homes with a total GDV of 1.15 billion. So Lakeside Homes is set to launch its 500 million GDV affordable homes in 2Q FY26, which has already secured a full waiting list, followed by the launch of its condominium phase in next year. So supported by strong pre-launch demand and a phased rollout strategy, the development pipelines position the segment to achieve record high revenue through FY28. Okay, so moving on to its facility management, large chunk of its profit and revenue come from the KL Tower concession projects. So Visit Malaysia 2026 act as a traffic catalyst for KL Tower contract. So post-listing, LSH expanded into the facility management space, securing a 20-year concession in April 2025 to operate KL Tower, establishing a new recurring income stream. Since the takeover, ticket prices have increased by 80%, and with traffic remaining steady, while shop floor occupancy improved significantly from 50% to 82% year-on-year. There is potential for rental rate revisions after 2 years, which could further enhance recurring earnings. So with Visit Malaysia 2026 expected to drive higher tourist arrivals, KL Tower's traffic outlook remains positive. Additionally, the 72.2 million ancillary facility management over 5 years presents a potential construction opportunity for RSH. So as per valuation-wise, you can see in my figure 10 and 11 that the 10 years average Bursa Malaysia Construction Index is trading at an average of 13.6 times. So based on an ascribed PE of 13.6 times on its FY27F earnings, we derive a fair value of 3.02 ringgit. So key risk for our earnings forecast as well as the upside will be hike in raw material prices, lower than expected take-up rate and order replenishment rate, as well as delay of projects. So Lim Seong Hai, we are giving a fair value of 3 ringgit and 2 cents. That is a potential upside of 72% from its current share price of 1 ringgit and 75 cents. So backed by industry-leading margins, which we have a net profit margin of more than 20%, a net cash position, and consistent dividends, which they pay quarterly. Its current 8 times FY27 FPE and 3.8% yield is undemanding. Yeah, that's all from me. I'll move on to the next speaker. Okay, sorry, I'm the last. So thank you everyone for dialing in for today's morning kappa session. We hope to see you guys again tomorrow. Thank you.